US markets see the strong start to Q2 earnings season, but threat to Fed's independence remains an overhang. India-US trade deal uncertainty makes investors nervous, and why Uber is already winning the AV race. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode 134 of the Stock Doctor podcast. First of all, my sincere apologies. I had to deal with a very personal emergency last week. That's why you didn't have any episode. There was no episode last week. Couldn't find the time to record it. The usual time where which record had to deal with some stuff. Everything's okay. Everything's fine. It's just that it was last minute, and as a result, I couldn't find the time to record it and release it on time. But I'm sure, even though there was no podcast, I sure hope that you guys enjoyed reading my analysis on Netflix, my new latest investment idea, latest investment thesis on the back of its Q2 earnings report that's exclusively published on Seeking Alpha. So I did post it on my LinkedIn. You can go check it out. The link is there. So while there's no episode last week, there's at least a new investment analysis for you guys to enjoy and hopefully gain some insights. Right. It's good to be back. It's very good to be back. And I have to say, it's both encouraging and scary to see the degree of bullishness in the US markets. That's how I'm going to start the entire episode with. I mean, volatility continues to be the name of the game, but my word, despite all sorts of macroeconomic uncertainties, from whipsawing tariff policies to the Fed independence remaining under threat to ongoing geopolitical uncertainties, through all of this, markets have continued to hit record highs pretty much every day. I mean, there was a slight drop on Friday when President Trump announced an additional 15 to 20%, 15 to 30%, up to 15 to 30% tariffs on EU. There's a slight drop, but overall, it's been one record finish after the other, especially for the S&P 500 and the tech-heavy NASDAQ. And last week was no different, as a combination of solid start to Q2 earnings season, along with some upbeat economic data, drove markets to a record high again. Once the dust had settled, S&P 500 jumped 0.6%, and the tech-heavy NASDAQ jumped 1.5%. The Dow was the only loser, albeit if I'm saying marginal decline of 0.1%, is it really a loser? It's just essentially flat, essentially, isn't it? So, I mean, and given the fact there's so many uncertainties, varying degree of uncertainties, I don't think a 0.1% decline would matter much, especially given the fact the other two indices, especially the tech-heavy NASDAQ, hitting new highs, thanks courtesy of the likes of Nvidia, Meta, Microsoft, and the usual suspects. Nvidia, remember, in the time, I couldn't record the show at the time, but in this last 10 days, it has become the first ever company to close at a $4 trillion valuation. $4 trillion, and people are already talking about the road to 5 trillion, some even saying the road to 10 trillion. But such has been the level of bullishness. People just think that this will go on and on and on. Now, let me welcome you to the first segment, Doctor's Welcome Weekly Snapshot. And let's kick things off with the first element that was a market driver, positive market driver, which is the big bank earnings. And all the earnings from the top big banks, which officially kickstarts the new earnings season, all of which were incredibly positive. Major US banks all capitalized on recent market volatility, driven by uncertainty over tariff policies, potential political risks surrounding President Trump, and questions about Federal Reserve independence to generate significant revenues and profits through their trading platforms. Major banks such as JP Morgan Chase and Bank of America reported notable increases in trading revenues for the second quarter of 2025. JP Morgan's trading revenue, and specifically, it rose 15% year over year to $8.9 billion. Banks are certainly increasing the amount of capital allocated to their markets division to take advantage of this heightened trading activity. Now, I did tell you volatility is the name of the game. Markets may be setting record highs, but the volatility is very much there. So, and with more volatility, that's more trading revenue for the banks. So they are setting aside more capital to their trading divisions. And why wouldn't they, right? Now, you got to and just to give you an example, Bank of America raised its global markets segment capital allocation from $45.5 billion to $49 billion compared to previous year. Now, you've got to keep in mind, there are regulations. Things are not like all rosy, things are not like pre-2007, where banks could trade on client deposits and they could do whatever the hell they wanted. Regulations are still there, such as the Walker Rule, which restricts proprietary trading, and stress tests penalize certain risk exposures. So there are regulations in place. But the thing is, banks can still profit by facilitating higher trading volumes, providing more financing to clients, a practice that uses more balance sheet resources but doesn't necessarily increase direct market risk. So it's not like, yes, regulations are in play. It's not the Wild West. Definitely not the Wild West. It's not pre-2007, but there are other ways with which markets can allocate capital. They can lend more to their clients for trading, and they can set aside, they can provide higher financing to clients, facilitate higher trading volumes, all of which will give a boost to balance sheets, but not necessarily increase direct market risk. So the banks are playing within regulations, but they're trying to maximize maximize the advantage that they now have because of heightened trading activity, because of higher volatility. And the good news for the bank investors, is that this trend is unlikely to end anytime soon. And this is because recent and potential regulatory changes may actually allow banks to take on more government treasury bills with less impact on leverage ratios, further freeing up capital for trading without breaching regulatory requirements. And as long as this high volatility environment remains, banks are likely to continue to benefit regardless of market direction, either through active trading or future opportunities to redeploy capital more profitably. Another key takeaway from the bumper earnings reports of the big banks is that they all indicate that the broader US economy has shown unexpected strength. And if you've been following this show ever since President Trump's tariffs policies have been announced, in few episodes, nearly 25 episodes, I believe, not 20, 15 episodes since then that have been released over tariff, and the volatility. One thing's for sure, despite this pandemonium and despite a lot of people calling for recession and despite calling for a lot of people calling for the entire world to go crumbling down because of all these tariff policies, the US economy has actually shown unexpected strength. And this particular trend has been seen in the recent bank earnings as well. President Trump's delay and modification of planned tariffs, along with a major tax bill passed by the Congress, have actually improved the economic outlook. JP Morgan chief executive Jamie Dimon noted that economists at JP Morgan, who initially predicted recession after the tariffs were announced, have reversed their forecast due to these positive developments. He described the current environment as a soft landing period of resilience. Remember, Mr. Dimon is known very well for some very colorful adjectives describing the economic scenario. There were hurricanes, there were tornadoes. Apparently, he's a big fan of weather, not just any weather, but nasty weather conditions. But his take is always insightful because he always uses very colorful adjective. Huge respect. I've got huge respect for Mr. Dimon. I think I'm a huge fan. And so he calls the current environment as a soft landing period of resilience, whatever that means. It essentially means we keep talking about the soft landing of the Fed. Now it's a matter of, so he's taking that analogy and just putting it to the resilience shown by the US consumer, resilience shown by the economy overall. And while he continues to warn about potential investor complacency and lingering credit or inflation vulnerabilities, he did acknowledge that the positive economic signs stemming from the recent tax legislation and policy shifts are likely to keep the US economy, are likely to maintain resilience in the US economy. Furthermore, credit card spending at JP Morgan rose 7%. At Citigroup, branded card spending increased 4%. Consumers boosted their outstanding credit card balances, thus raising bank revenues. Executives indicated that despite some tariff-driven price increases, as things stand, and remember, this is an evolving situation, as things stand, there is no serious concern about credit deterioration, further reflecting stable consumer health. Now, I did tell you multiple times over the previous episodes, the US consumer remains, is pessimistic. He or she is pessimistic. Their consumer confidence continues to be at a low. But when it comes to resilience, when it comes to stability, when it comes to actual spending, there is a lot more stability. There's a lot more positive outlook as far as the US consumer spending goes. And that's exactly what you are seeing from these bank earnings as well. Speaking of the US economy, in addition to the big bank earnings, we also received the key inflation data. And the main takeaway from all of this inflation data, which I'm about to talk to you guys in a bit, is that while inflation continues to remain under control, the tariff effects are indeed starting to show up as companies finally start to pass on the prices to consumers. More specifically, you have the CPI that rose 2.7% year over year in June, up from 2.4% in May, and core inflation hit 2.9%. Inflation did match economists' expectations, but the monthly rise, 0.3% monthly rise, so 2.4% in May, 2.7% in June, so that 0.3% rise was actually the highest since January, which actually, what does it tell you? It actually tells you that the tariff impact is finally starting to play out. Notably, furniture, toys, and clothes, tariff-sensitive goods, saw bigger price hikes, while car prices fell unexpectedly. We also got the PPI data, the Producer Price Index data, which actually stayed unchanged in June after a 0.3% rise in May. And the 0.3% rise was revised upward. Yeah, it was not the initial data, but they always do these revisions. And it was revised up 0.3%. So there was a rise in 0.3%, but in June stayed flat. Now, whether the June will be revised up or not, we will only know in July. But for now, you can take the news that the PPI data, the inflation remained unchanged in June. Over the past year, wholesale prices increased 2.3%. Now, this data follows a period of moderate consumer inflation, but it does begin to show the rising goods prices as new tariffs take effect. I want to keep in mind that the PPI is actually a very closely watched metric as the input for the Fed's preferred inflation. So PPI serves as the input for the Fed's preferred inflation metric, the one that it uses to determine whether we do increase rates, decrease rates, keep rates unchanged, or so on and so forth, the PCE index. So it's an input to the PCE index, which is the preferred metric for the US Federal Reserve. The question then becomes, what do we make of all this inflation data? Well, for starters, it shows that, as I mentioned earlier, while inflation continues to remain subdued for now, the impact of tariffs are finally starting to be felt by the US consumer. Tariffs are feeding through to higher prices on certain imported goods such as furniture, clothing, metals. June saw the fastest monthly core goods price increase in 3 years, and the US effective tariff rate reached 20.6%. So the effective tariff rate of the United States is 20.6%, which is, believe it or not, the highest since 1910. So nearly a 115-year high is what we're talking about. Though the economy's resilience has surpassed Wall Street expectations, as in growth is still positive, major bank reported strong earnings, all in all, analysts continue to caution that tariff-driven price hikes could become self-enforcing. The only positive news is that despite higher input costs, notably steel, aluminum, and copper, overall inflation hasn't surged because services inflation, the other side, is goods inflation, the services inflation. So services inflation, the other aspect of inflation, especially in areas like shelter and travel, has actually softened. So there is an offsetting effect. It's not that the tariff impact is not starting to trickle into the economy. It's just that there is an offsetting force that is keeping inflation subdued for now. And with President Trump moving goalposts when it comes to imposition of reciprocal tariffs, first it was April 9, then it became July 9, now it's August 1st. And with the president threatening to impose more tariffs on certain nations and blocs like BRICS, EU, Japan, South Korea, for example, and more sectors. You think about pharma, where he wants to impose a 200% tariff on pharma goods. All this uncertainty. Point I'm trying to make is all this uncertainty makes it difficult to predict the future inflation trend. And what it does make it difficult, it also makes it difficult for the Fed to determine what to do with the interest rates. And ladies and gentlemen, this brings me to the latest drama and the most significant drama that you and I, as US investors, will need to keep an eye out for the foreseeable future. And that is the latest drama, which is the very independence of the Fed could be currently under attack, as President Trump appears to be hell-bent on finding a way to fire Fed Chair Jerome Powell. Although the president keeps denying, at the press conferences, there's a lot of backdoor, there's a lot of back-channel negotiation, back-channel talks happening, a lot of talks happening in the background, whereby he's visibly upset with the Fed chair. And the latest twist actually includes, believe it or not, a Fed building renovation plans, which the Trump administration is looking into as a means to fire Chair Powell. Now, more specifically, President Trump and his allies have focused on the ballooning costs of the Federal Reserve's $2.5 billion headquarter renovation as a lever to attack Jerome Powell, Fed Chair Jerome Powell, and erode his credibility. While the president likely lacks legal grounds to fire Jerome Powell over monetary policy, the White House is broadcasting the building cost overruns as alleged government waste, aiming to damage Chair Powell's reputation and pressure him to either resign or submit to political directives. The effort focuses on generating negative sentiment around Chair Powell, echoed by pointed social media posts and demands for investigation, shifting criticism from abstract policy disputes to tangible allegations of mismanagement. The end goal is pretty simple. And I'm going to tell you this once again. I've been telling you over the past 133 episodes of the show. Why not say it on episode 134? The Stock Doctor podcast is not a political show. This is a pure finance show. It's a pure show that tackles the US and Indian markets. I'm not going to get into a political debate of what is right and what is wrong, and whether President Trump is right to fire Chair Powell or not, what it means for Chair Powell himself, what it means for the Fed, what it means for White House, all of that. I am not going to I'm not going to give you a political insights for two reasons. One, this is not a political show, as I've told you multiple times. Second, I'm not a political analyst. I barely call myself a finance expert, even though I've got the advanced degrees and the experience. I don't necessarily consider myself as an expert or a influencer on finance. So let alone political insights. So I'm not going to discuss political insights here. This is a pure case of market sentiment. How, as I as an investor, look at all of this drama that is unfolding and between the battle as a result of the battle between Fed Chair Jerome Powell and President Trump. So so don't take this as any political attack, or don't take this as any support for anyone or any negative impact on anyone. I'm not, going negative on President Trump's actions, not going negative on Chair Powell's actions. It's nothing to do that. I'm looking at it from purely market perspective. Okay, you want to look at the political insights, go watch some other channel, some other media shows, plenty of podcasts out there. Not this one. All right, now, coming back to the market perspective, I'm a firm believer that interest rates should be reduced. All right, it's very simple for me. And this is not because I have absolute support for President Trump, or President Trump has asked me to say this, or I don't like President Trump, but it's still fit. No, this is nothing to do with any political bias. All I'm saying is I'm a firm believer because interest rates should be reduced, because last two episodes, or at least 3 episodes back, I did tell you that there is weakness in the labor market. There are chinks in the armor that is being shown in for the labor market. There is labor market weakness genuinely coming, and inflation is not going up. Put simply, if you want to say, if you don't want to break the US economy, I believe that the interest rate should be reduced. Now, so I am a firm believer that interest rates should absolutely be reduced. But I don't support the erosion of Fed's independence in any way, shape, or form. Again, this is not an attack against the White House, not attacking against the president, not a genuine vote of confidence for Chair Powell, nothing of that. I simply think overall, if you look at the past 3 years or 4 years, Chair Powell and co have done a phenomenal job. And it's not Chair Powell himself, it's the entire Federal Reserve, the FOMC, right? I think they've done a great job given the circumstances. But that is not all. As an investor, I see the erosion of Fed's independence as a significant threat to the US markets, both in the short term and the long term. This is because the Fed's independence has historically served as a stabilizing force during global financial crisis, enabling rapid nonpartisan interventions to prevent contagion and support the global economy. If the White House, no matter who sits in the White House, undermines the Fed, markets could simply lose faith in the determination to control inflation and act decisively during a crisis. Politicized rate cuts could backfire, with market participants demanding higher yields on long-term debt simply out of the fear that the Fed won't fight inflation. And the consequences of this is that the long-term borrowing costs automatically go up, thereby destabilizing markets. The very thing, the ironic part of all of this is the very thing that President Trump is looking to avoid. He wants to bring interest rates down because he wants to reduce government borrowing costs. The problem with erosion of Fed's independence is that the investors would demand higher yields, long-term borrowing costs would go up. And the end effect is far worse than what the president and the White House is trying to achieve right now. So it's simple. It's pure market dynamics. It's pure market elements, nothing to do with politics whatsoever. So while murmurs continue to exist that President Trump will, at some point, make a play for Chair Powell's exit, for now, the president remains in denial mode. And for the US markets, for US investors like you and I, that's actually good news, especially since Chair Powell only has a few more months left before his term as chair ends. While legal, institutional, and market checks may constrain the ability of any administration to completely politicize US monetary policy, even the perception, just the perception, remember markets are driven by behavioral sentiment, behavioral factors as well. Just the perception of interference is enough to rattle markets and shake global confidence in the American financial stewardship. No investor wants that. And given that markets are hitting records every week, any such negative development would lead to an absolutely sharp correction, and the entire confidence in the US economy, US markets could be completely shaken. Investors, therefore, have to keep an eye on this development. There is no excuses. Forget your political affiliation, forget your political alliance, forget either whether you're apolitical, Republican, Democrat. I don't care what your political affiliations are. As if you are a US investor, the erosion of Fed's independence is simply not good for you. And as a result, you simply have to keep an eye out for this. I know the big tech earnings are coming this week. This week as things stand, Microsoft, Google, all of them will be reporting in the next few weeks, barring Nvidia, which comes later. I know the big tech earnings will take the spotlight with next week, in the coming week. But the potential erosion of Fed independence, to me, as far as I'm concerned, as far as this podcast is concerned, remains one of the biggest, if not the biggest threat out there now. I'm going to stop my rant on the US markets, not for US politics, US markets. I'm going to head straight to the next segment. The doctor goes home. So I'm sorry for being very, very vociferous when it comes to telling you how much political show, because I always, whenever I mention my opinion to people, they always try to make it political, and I'm like, no, I have no political affiliation. Okay, I care about making money, and I hope to share my insights with you guys. And hopefully you take some of it or not. It's completely up to you. This is a platform where I can talk to you guys, but it would be completely about markets and nothing else. I don't discuss politics, never have, never will. Right, needed some water there. It's very humid in London. Temperatures are better, but it's extremely humid, right? We're not talking about London. We're going straight to India now. So welcome to the Doctor Goes Home segment. And the earnings season has kicked off in India as well, with heavyweights such as Reliance, ICICI Bank, Bharati Airtel announcing their results. It's not been a particularly great start to the earnings, and I'll talk to you guys more about that in the coming weeks. All I'm telling you is it's not been a particular great start for the earnings season, and that has kept Indian markets under pressure. However, we also had inflation data that showed that retail inflation came in at about 2.1%, and it was one of the lowest in recent times. So there was some positive sentiment there. With the subdued start to the earnings season, is sort of a problem has been putting pressure on the markets. All of these, look, inflation, earnings, all of these are market movers. But the one area that has certainly taken on a much greater focus in the Indian markets in recent times is the news and the uncertainty related to the India-US trade pact, the bilateral trade agreement between the US and India, which has been rumbling on with no end in sight. Long story short, there's still not been any major developments on this front, and that has definitely kept markets jittery, and is one of the major factors why the Indian markets continue to remain under pressure in the last few days or last few weeks. Last week saw the 5th round of trade talks between India and the United States, but still nothing. Nothing to report. It's nothing but uncertainty. Led by Rajesh Agarwal, India's chief negotiator and special secretary in the Department of Commerce, the Indian delegation engaged in 4 days of intense discussion with their American counterparts. Not for the first time, not for the second time, not for the third time, not for the 4th time, but for the 5th time. Despite these ongoing deliberations, no conclusive agreement was reached. Several key issues remain unresolved. Almost makes you wonder, what do they speak in these rooms, right? Always wondered, anyway. So no. It's been going on and on and on. No end in sight. And investors like you and I are jittery. Okay, all of us are jittery and have every right to be jittery. Unlike nations and blocs such as EU, Vietnam, and the UK, India has actually adopted a more measured approach when it comes to these trade talks and has not buckled under any sort of pressure. In fact, Union Commerce and Industry Minister Piyush Goyal made it very clear last week that India will not be rushed or pressured into signing a trade agreement that does not align with its national interests. His quote, "If India gets a good trade deal, we will go ahead with it. If not, we won't. India always keeps the country's interests first." This was his quote after the talks concluded. Piyush Goyal also criticized any attempts to shift public opinion via the media during ongoing sensitive negotiations, emphasizing that talks happen only in the negotiation room. He described New Delhi's approach as disciplined and professional and subtly rebuked Washington's pressure tactics, such as setting public deadlines or shaping narratives. Now, despite all these rebukes, despite all these uncertainties, so on, while the relationship between the two nations remains strong and cordial, several issues remain that is preventing from securing a trade deal. For instance, the US wants more access to agriculture, digital trade, intellectual property, and medical devices. India, on the other hand, not only wants to protect agriculture, dairy, and other sensitive domestic sectors, but also wants better access for its IT services, textiles, and pharmaceuticals. Remember, the President Trump is actually thinking of imposing a 200% tariff on pharma. So not great news for Indian pharmaceuticals. Probably now you start to see why these talks are not reaching any conclusion. Now, India's measured and self-assured stance highlights increasing economic confidence, and that's great thing for Indian investors. However, some sort of uncertainty is very much needed, and a reluctance to repeat asymmetrical trade agreements of the past. The strategy so far appears to be working. So while President Trump sent letters to the likes of EU, Japan, and South Korea, indicating that they will be subject to their respective reciprocal tariffs from August 1st, despite the tough stance that was taken, India has so far not received this letter, which suggests that the United States does believe that a deal can still be clinched. Both sides have agreed to keep the dialogue open, with India planning to internally review the outcomes of the latest round and adjust its strategy if needed. All of this is good news, but India Incorporated is very nervous and has every right to be. Dry fruit importers, for instance, are delaying customs clearance of walnut, almond, and other nut shipments from the US, anticipating potential duty cuts of up to 50% as part of the trade. Importers are hoping to avoid losses if tariffs drop post-clearance, but their actions risk further supply disruptions. Some have actually chosen to store goods in custom-bonded warehouses to avoid immediate duty payments, despite higher storage rents. Furthermore, multiple sectors are adopting a wait-and-watch mode due to this trade cliffhanger. For example, manufacturers like Dixon Technologies and Carbon Group have reported that although exports have continued, US clients are actually postponing new orders pending clarity on trade talks and comparative tariff regimes with China and Vietnam. Export orders for the gems and jewelry segment, especially those targeting the US holiday season, are being postponed or reduced. US buyers are negotiating short-term arrangements and are wary of higher prices due to the uncertainty about the future tariffs. The textile and apparel industry, same situation. It's cautiously optimistic that India could secure relatively favorable tariffs compared to competitors, but businesses are indeed holding back large orders due to the volatile tariff landscape. There is broad consensus among major sectors, electronics, apparel, gems and jewelry, seafood, that the uncertainty is actually undermining business planning, slowing new client onboarding, and affecting both short and long-term export commitments. As such, it is extremely vital that a breakthrough is made with respect to this bilateral trade agreement between the two nations as soon as possible, not just for the companies, but for investors like you and I who invest in these very sectors. Now, there are some sectors that have every right to be nervous. Electronics is one such example. Now, India's electronics exports, last week's data showed that surged by 47% in the April to June quarter of FY26, totaling $12.41 billion. Now, this strong performance highlights India's growing integration into the global electronics supply chain and reinforces its role as a significant alternative manufacturing hub in Asia. But that is not why the electronics sector is worried. News is good, but here's the catch. The reason why electronics companies are biting their nails is because the United States was by far the top exporter for the segment. 60.2% of the $12.41 billion of exports in electronics actually went to the US. Let me give you some comparison. Second highest export share was UAE. And you know what the export share was? 8.1%. Where is 60.2 and where is 8.1? Yeah. Electronics sector, electronics industry, electronics companies have every right to worry. Like I said at the start, the earnings season has been a very subdued one so far. That has been a headwind for Indian markets. But make no mistake, ladies and gentlemen, there is no bigger factor right now that is pressuring Indian markets than the uncertainty surrounding the Indo-US trade deal. Markets hate uncertainty, whether it is India, whether it's Japan, whether it's UK, whether it's US, I don't care which markets you want to pick any markets. One of the fundamental lessons is markets hate uncertainty. The fact that there has been no breakthrough, even after 5 rounds, not one, not two, not three, not four, but 5 rounds of talks, is only going to give investors more headache. Until and unless this trade deal is sorted, ladies and gentlemen, expect this jitteriness, expect this uncertainty, expect this nerves, expect biting the nails, expect the markets to do all of this. So as Indian investors, if you're investing in the Indian markets, all I got to say is buckle up. And with that, might as well buckle up, because we're going to enter the Dr. Dissect segment, and it's buckle up has a relationship to it. I'll explain after I sipping some water. Warwick is not sponsoring, okay? Just to let you guys know. This is just my water boy. I enjoy the water, but they've not asked me to sponsor it in the video, right? Welcome to the final segment, Dr. Dissects, and my favorite name makes a comeback this week. And it has all the relations. It has a connection to the buckle up, because the stock that's going under the microscope is the ride-hailing giant Uber Technologies. Ticker symbol Uber, UBER. I know it's a bad joke when I said buckle up. Yeah. So, but anyway, Uber Technologies is going under microscope. Uber reported their Q1 earnings about a month and a half back. And if one looks at Uber's Q1 numbers, then one of the first major takeaways would be the sharp deceleration in the growth rate of gross bookings, with mobility being the main culprit. More specifically, from a 17.6% year-over-year growth in Q1 saw total gross bookings growth rate sharply decline to 13.7% year-over-year. While both mobility and delivery gross bookings both registered a decline in growth, mobility had a steeper decline, going from 18.2% in Q4 to 13.5% in Q1. What is slightly concerning to me as an Uber investor, and I've been a long-term Uber bull, no changes to that. Continue to love the company, continue to love the name, Uber continues to be the biggest position in my portfolio. Nothing has that changed. But what is concerning to me as an Uber investor is that the decline in growth is not restricted to Q1 alone. On the contrary, there has been a steady pattern of decline in recent quarters, with Q4 actually being the only exception. And the trend is the same for adjusted EBITDA as well. Uber's management was asked about this decelerating trend during the Q1 earnings call, and they attributed the decline in gross bookings growth to a higher growth in trips internationally relative to the US, which affected the overall price mix, subsequently affecting the gross bookings growth. Now, while this makes sense, investors, in my opinion, should keep a very close eye on this trend going forward to see if the situation improves, especially with respect to adjusted EBITDA. Uber's management during the last investor day had projected adjusted EBITDA to grow at high 30s to 40% CAGR over the next 3 years. While there is no threat to this target today, should this downward trend continue, then it would certainly be a cause for worry. So if you are an existing investor or looking to get into the name, it's certainly a cause for worry. These are the trends that you should be looking at. Now, while I find these trends to be concerning, I don't find them alarming yet for multiple reasons. Firstly, such a trend has occurred in the past. Okay, more specifically, the gross bookings growth rate declined from the second quarter of FY22 to the second quarter of FY23 before picking up again. As for adjusted EBITDA, while the growth rate has decelerated, one has to keep in mind that adjusted EBITDA was doubling and tripling in FY22 and FY23. Such a growth rate is simply not sustainable for the long term. And one could view the current trend as stability settling in. So investors should keep a close eye on the growth trend, but there is absolutely no reason for them to panic yet, in my opinion. So just because you got to keep a close eye doesn't mean necessarily you have to go into panic mode, right? So that's the whole message that I'm trying to send you when it comes to Uber's gross bookings and adjusted EBITDA. Second takeaway, if one looks at Uber's other key metrics, a lot to cheer. For instance, monthly active platform consumers, what people call MAPCs, are growing at a steady rate with each passing quarter. And adjusted EBITDA as a percentage of gross bookings is also growing at a steady rate, which demonstrates how the company has become more disciplined with each passing quarter. Finally, Uber continues to be a free cash flow generating machine. Q1 was absolutely no different, with operating cash flows registering a year-over-year growth of 64% and free cash flows registering a year-over-year growth of 66%. Overall, when I look at Uber holistically, while there are certainly areas of concern, overall the business continues to remain on a very solid footing. Having said that, given the challenging macro environment that the company finds itself in today, it is vital that Dara Khosrowshahi, CEO, and company, I never get it 100% right. Apologies, Dara. Continue to adopt a disciplined approach and ensure that they stem the decline in the growth rates, especially with respect to adjusted EBITDA. So that's the first takeaway that I can talk to you about. The other key takeaway, and this is probably more important for long-term investors like you and I, because this other takeaway that I'm about to talk about is literally built for the long term. The other key takeaway from Uber's Q1 report is the progress made by the ride-hailing giant when it comes to autonomous vehicles or AVs. Management announced during the earnings call the partnership with Waymo in Austin was progressing well with healthy opt-in rates and ratings. The company also announced that there was a very high utilization of the AVs in terms of daily trips, with the average Waymo in Austin busier than 99% of Austin's traditional Uber human drivers in terms of the number of trips per day per Waymo. Moreover, the company also announced a new AV partnership with Pony AI, under which robotaxis will be launched in the Middle East later this year. Uber also announced earlier this week that it has expanded its partnership with WeRide, through which autonomous vehicles will be rolled out in 15 additional cities globally over the next 5 years, including in Europe. More recently, deals were also inked with the likes of Baidu and Lucid when it comes to AV deployment. The last time I talked about Uber, I mentioned how the market's obsession over the notion of autonomous vehicles being a serious threat was false. I also argued that Uber had the potential to be a ready-made partner for AV companies. Q1 proved this to be the case, and subsequently over the last few months and last few weeks, it has continued to be the case. It has proven to be the case, and I would expect more partnerships in the coming quarters. I don't think Baidu and Lucid are the end line. Tesla has already entered, Austin in terms of their robotaxi business. I think they're also setting up now plans to license it to Arizona. I mean, they're getting permits for Arizona. Fantastic, great. I just don't see their entry into the space is going to change or going to be any meaningful threat to Uber. I think Uber's winning the AV race already, even before AV races started. Now, Tesla would be a phenomenal threat, formidable threat, no doubt. Is going to dethrone Uber? Highly unlikely as far as I'm concerned. Now, Tesla bulls will always expect, Tesla fans. I'm sure I'll get a lot of flack for it, but I'm not changing my opinion for that. Now, got a book, got a pen that can mean only one thing. We're going to talk valuation. Now, last time I discussed Uber, I had projected FY25 gross bookings to come in at $192.1 billion, representing a year-over-year growth of 18%. As mentioned earlier, year-over-year growth rate in gross bookings has been steadily declining, with the growth rate of gross bookings in Q1 in particular showing a sharp deceleration. The company, as mentioned earlier, expects Q2 gross bookings to come between $45.75 and $47.25 billion. If you take the midpoint, which is $46.5 billion, that would represent a year-over-year growth of 16.4%, better than 13.7% year-over-year growth it registered in the first quarter. Moreover, in Q1, the gross bookings came in at the midpoint of the company's guidance. If one takes the last 5 quarters, the company on average has registered a year-over-year growth of 17.2%. So I've assumed Q2 gross bookings growth of 16.4% and a growth rate of 17.2% for Q3 and Q4. At these growth rates, Q2 gross bookings would be $46.5 billion, Q3 would come in at $48.01 billion, Q4 would come in at $51.8 billion. You take it all together, total. So first of all, talking Uber, total gross bookings for FY25 comes up at $189.1 billion. $189.1 billion, and that's gross bookings, $189.1 billion, slightly lower than my previous forecast of $192.1 billion. Now, the company expects adjusted EBITDA for the second quarter to come in between $2.02 and $2.12 billion. The midpoint of this estimate, $2.07 billion, would represent a year-over-year growth of 31.8% and represents 4.5% of the gross bookings. If one looks at Uber's past few quarters, the adjusted EBITDA as a percentage of gross bookings has been sequentially going up on average by 0.2%. I have assumed this magnitude of increase for Q3 and Q4. This would mean Q3 adjusted EBITDA would be 4.7% of gross bookings. Q4 adjusted EBITDA would be 4.9% of gross bookings. This implies Q3 adjusted EBITDA would be 2.26 billion. Q4 adjusted EBITDA would be 2.54 billion. So total adjusted EBITDA for FY25 is now projected to come in at $8.7 billion, marginally lower than 9.1. So 189.1 billion is the gross bookings. 8.7 billion is the adjusted EBITDA, marginally lower than my previous estimate of 9.1. Now, according to Seeking Alpha, Uber currently trades at a forward EV to EBITDA of 22.1x, marginally higher than its long-term median of 21.5. Despite the strong growth seen in adjusted EBITDA, given my lower projections of the whole metric, I have lowered my multiple of Uber from my previous estimate of 23.9 to the historical multiple of 21.1. So EV to EBITDA multiple was 23.9x, scratch that, now becomes 21.5x. So it was 23.9 EV to EBITDA, scratch that, new one is 21.5x. Now, at this multiple, the company's enterprise value or EV would then come in at 187.05 billion, 187.05 billion. So company's EV enterprise value is 187.05 billion. You add cash of 6.03 billion and you subtract debt of 9.58 billion. Okay, you add cash so to get the equity value. So you add cash of 6.03 billion, subtract debt of 9.58 billion, you get the equity value becomes 183.5 billion. Okay. At that, you become 183.5 billion becomes the equity value of Uber. Now, company has 2.08 shares in free float, which results in a price hike. So basically, you take 183.5 divided by 2.08, and you get a brand new price target of 89. 89 is the new price targets, lower than my previous price target of 103. And 89 is around the levels where it's trading. It closed around 90 on Friday. As the time of recording, it's just, I think it's still floating around that level. So essentially, it's exactly where it is. There's not much upside left. Now, Uber's momentum is also not particularly great, as evidenced by a short-term momentum grade of C+ on Seeking Alpha's momentum scale. So when you take it all together, you barely any upside from current levels. You have a weakening momentum. When you take it all that, what I am going to do is I'm going to downgrade it from a buy to a hold. So my initial rating on stock, my previous rating on the stock was a buy. Scratch that. New rating is a hold with a price target of 89. Price target 89. Buy was the initial rating. Scratch that. Hold is for Uber. Okay. So bottom line, Uber had a mixed start of the year with a miss on the top line, but a beat on the bottom line. Company also generated strong free cash flows. While both gross bookings and adjusted EBITDA generated strong double-digit growth, the growth rates of both these metrics have been showing a pattern of steady decline in recent quarters. Not a cause for alarm yet. Investors should certainly keep a close eye on these metrics in the coming quarters, especially since the macro environment has become challenging. The recent quarter also saw Uber's AV ambitions progress to the next level. Its partnership with Waymo in Austin is progressing very well. Companies brought the total number of partnerships with AV players to 18, actually 20, Baidu and Lucid included. With Pony AI, Baidu and Lucid being the latest partners, any talk of AVs being a threat to Uber is becoming more farcical, as far as I'm concerned, with each passing quarter. Uber is finally getting the recognition it deserves, make no question about it. So I'm not saying, I'm under no circumstances am I saying sell Uber. I'm just saying hold Uber. Maybe it's wait for better levels, better entry point for the company, for you to enter if you haven't invested in Uber yet. And this is because the year to date, the stock is already up 50%. Okay, year to date, the stock is already up 50.2%. So, clearly there's no point chasing it at current levels. Wait for a pullback and then go in. It will always be, for me, Uber will always be buy a weakness name as things stand. I'm not saying always. It's like never say, never say always. Because when it comes to stock markets, you can't be mostly attached to any stock. For now, as long as the story remains the case right as it is, it's a buy on weakness name. Whether it'll change in the future, we don't know. But for now, I am maintaining my hold rating on the stock, but that does not mean that I'm negative in any way. All I'm saying is, based on the moves that it is making in the AV space, Uber, despite a 50.2% jump in the stock, despite giving some stellar performance, is simply not resting on its laurels. That's all the time I have for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttam Vinay, UTHAMVINAY. I should probably say do X me at, but don't know whether that's right. Anyway, do tweet me at Uttam Vinay, UTHAMVINAY, or email me on the Stock Doctor Podcast at gmail.com. It's good to be back. I will be back again next week. Thank you once again for listening. See you next week. Until then, ladies and gentlemen, stay safe and make some money.